Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show.
Todd, this is a good look. This is a new Tuesday night look for you. Oh my gosh. Hi, everyone. Welcome to another Tuesday night. Todd has really lost his mind. I don't know. We're working long hours here.
Hey, everybody. And you're not kidding, man. We are slammed. We're so busy. Welcome to our Tuesday Night Podcast, guys. We are live. We're going to talk about a lot tonight. I am getting so many calls. In fact, I had a call yesterday. It was almost like a panic call from one of my clients that actually moved out of state. And it's a young guy, and he makes pretty decent money. And I have talked him off the ledge twice so far on him not buying a house right now. And I just feel like every couple months, man, bam, he's back at it again. He wants to jump in. This time he may do it, Melissa. This time he may do it. He may dive in. Guys, we are going to talk about what is going on in the market right now, because I know what you're saying. And I hear from people all over the country, and it is so spotty. You know, some areas are crashing big time. Some areas like where we are in Maryland, I mean, we're still seeing multiple offers, and, you know, but we are seeing a change. And guys, I'm telling you right now, after we talk about some things tonight, I assure you, I'm telling you, I'm not pivoting in my thought. I think the market is still hanging on by a thread, just like our title to this Tuesday Night Podcast. And we're going to dive in tonight's live show, guys. As you know, we'd love to hear from you. Chat your comments in, your questions. We want to answer them tonight. And yeah, Melissa.
Happy Valentine's Day. We can't forget it.
Yeah,
yes. Lots of love to all of you out there. But yeah, Todd, you're right. And I don't know what's going to happen here with the spring market. I'm actually thinking it has the potential to be very hot. I don't know. But, you know, just in our brokerage alone, from what we're seeing here in Maryland, we have listings coming on. We're very, very busy. And with listings that we have right now, multiple offers coming in on those listings. So it's very busy. We'd love to hear what's going on in your neck of the woods, if you're seeing the same type of thing, if you're seeing something different. But, you know, it seemed that we were having a slower November and December, but it's not appearing to be slowing down as much as it was in those months.
Yeah, Melissa, I think everybody can see my screen. I want to kind of start off this show tonight with going on. We were Maryland brokerage, and but we definitely keep our pulse throughout the country and from our awesome viewers and audience. I mean, you guys have been so amazing of keeping us abreast of what's happening in your city. But we have an amazing broker network all over the country that we frequently talk to. I'm in a couple different groups, Facebook groups, where we kind of, you know, talk about what we're seeing in their market. And, you know, and kind of, you know, just trying to get a pulse on, you know, where things are crashing the most. I see my buddy on here, Travis, Real Estate Mindset. Hey, Travis, what's up, buddy? Travis and I are in a group together, and half a dozen of us, and we kind of are really working together to bring you guys the most up-to-date information. But I want to kind of just go over what we're seeing as of January. As you guys know, we've spoke about this before. Real estate is sort of backward-looking data. Unfortunately, I can't help that. By the time it's not like the stock market. By the time all of the multiple listing services report in and we get some kind of a read, it just takes a while. And, you know, but we're looking at January data here, and I want to just kind of run through a couple of things because there are, I'm going to say there are three things that are happening right now in this real estate market. And that where everything, in my opinion, is hinging on this market. The first and foremost is the lack of inventory. And I know this is regional, and depending on whether you're looking at existing homes or new home construction, um, there's going to be, a big difference in available inventory because a lot of the new construction, these builders have to sell. We're starting to see where they're discounting the most. And it always happens that way. It happened in 2006 when we hit the peak. New home builders started crashing first in 2007, 2008. But I want to point out, because there's one thing, and that's lack of inventory, especially existing home inventory, lack of affordable housing. Okay. That's number one. Number two, probably the primary reason why we're still seeing the market in certain areas still selling and still kind of hot. Not as hot as it was a year and a half ago, a year ago. We're not seeing stupidity, like we had seen as far as people overspending. I hate to say it like that, but to me, it's crazy when somebody's spending $100,000 more than appraised value on a house and spending all their cash with no inspections and things like that. But so number two would be job market. The jobs market is still strong in a lot of major areas. We are seeing layoffs happening. But really, number three is the Fed. And, I know that it doesn't go hand in hand, exactly on raising the Fed rate or the overnight rate or the discounted rate where banks borrow and lend money. But when we see that go up, we know that consumer loan costs are getting higher, especially those that are affected by credit card debt. And typically the 10-year treasury bond kind of goes along with that. And so mortgage rates have a tendency to rise because, hey, why not invest in the 10-year treasury versus a 30-year fixed mortgage, if they're paying a decent, amount. So in order to kind of attract, money into the mortgage industry, you have to raise those rates so that these investors have an opportunity to make more money than they would in a 10-year treasury bond. So if that makes sense. But what I'm seeing, and along with that Fed, so I'm going to make that component number three, the Fed and / mortgage interest rates, because that is really dictating what people can afford on a monthly basis versus the cost of the house right now. But I do want to just kind of go over a couple of these charts because I want to show you the difference that's happening in just a year. Okay, so the component when I talked about inventory, okay, so when we're looking at active listings in the Mid-Atlantic region, all right, which is where we are, we're in Maryland, but really Delaware, West Virginia, Northern Virginia, New Jersey, Pennsylvania, that's really what our MLS, multiple listing service, consists of, the Mid-Atlantic region. So when we're looking at this, in January alone, we are up 40% in active listings, available listings for the market, and that's big. And if we go into closed sales, I want to show you that we are down year over year in January, the Mid-Atlantic region, we are down 33.4%. I was speaking with an agent in Nashville, Tennessee over the weekend, and I was asking her how they compared in January year over year and what was their average in, how far down or up or whatever in year over year sales. She couldn't tell me, but looking at these charts, I can tell you exactly where we are now. I have this on all types of ownership, including single family, townhouses, and condos, things like that. So that's that's kind of where we are as far as pendings. We are down 27.7%. Pendings are, things that are under contract. So just to kind of start you guys off, I want to lay the foundation here because this is going to be important for tonight's discussion, is that inventory is going up. And guys, this is as of January. We will see inventory increase. In my opinion, we're going to see inventory increase significantly over the next couple of months, because this is a time when sellers are going to start, they think it's the best time to list a house. I kind of think that, hey, if you're jumping in this market, if you're selling a house right now, I kind of think now's a good time to put your house on the market before a lot of the other additional inventory, if you're trying to reduce the amount of competition.
Mm-hmm. We are halfway through February already. Spring is approaching, and some parts of the country, it's extremely warm right now, and they are in the mindset to get their house ready to sell. So, yeah, I mean, this is going to be a very interesting time to see what happens here, see how hopeful the sellers are to get their home ready and get on the market. It's going to be a very interesting, really 30 days to 60 days, and we're going to see what kind of inventory we're going to have as a country.
Yeah, and we're seeing. I mean, Melissa, you can sort of talk about what we're seeing right now at our own brokerage, because I mean, we have offers that are going on the market, and I mean, we're getting multiple offers right now still.
Yeah, we are. We're getting multiple offers, and very quickly. They're coming in super fast. But again, it's nothing. It's no craziness. The craziness has stopped, and people are much more smarter. They're being guided more properly. They've taken their time. They've educated, really. So that's promising. That's good to see that we're becoming smarter as a whole, at least what I'm seeing. But I will also say that there are people locally here. There are lenders that we see are losing their jobs. There are title people as well that we know. There are people in this industry that are feeling it. And I think that that's going to continue.
We just had a meeting with an agent. Came in, did a show, a podcast. Was that when was that?
Monday.
Was that last week? Oh, Monday.
Yeah, yesterday.
Yeah. And I mean, we were starting this new channel, by the way, guys. It's called Real Estate Agent, and it's basically we're getting into doing so a lot more agent training and speaking with a lot of agents throughout the country and getting their opinion. And she kept holding back in this interview, finally I kind of time out and said, look, man, let it loose. I mean, what are you worried about? I mean, come on, let's talk real. And then she kind of said she's scared to death. And this is somebody who has been in the business for about 10 years, hasn't seen the downturn. But these agents that have been around, if they're being brutally honest, they have to say they're seeing 30-40% reduction in sales in 1 year, right? Guys, this is just the beginning, in my opinion.
Mm-hmm.
We're talking about, will the Fed pivot? I watched a interview that was after the last FOMC meeting. The new jobs report came out. Who knows where they get this data? But I mean, I personally know of companies that are laying off a lot and they're rehiring for less, right? So there's a lot going on with that. 1.9 jobs per unemployed person. I don't even, that to me is like freaking, that means nothing to me, right? But what this interview with Jay Powell, it was asked of him, if you knew a day after your FOMC meeting and your announcement, your press conference, if you knew that the job reports would be so strong, would that change the Fed's rate hike? instead of a quarter of a point, would it be more? Would it have anything to do with that, your decision there? And what Jay Powell said was, it shows that we can't pivot, basically. That looking at the strength of the job market, and I'm going to attest that what we're seeing here locally in Maryland, still madness, is showing me that we haven't scratched the surface yet to get inflation down to 2%, of which Jay Powell said they're not getting off of that number. So the only way to get there, because we're still way over that right now. So the only way to get there, guys, I'm not an economist, but I mean, the only way to get there is to either have I don't even like this word disinflation. I have no idea what that means. I know what it means, what they say it means, but what we need to see is deflation, because we need to see prices coming down or wages going way up. I don't see that happening anytime soon. But what they're talking about with disinflation, this 2% year over year, means we have got to keep going and stall price hikes, price increases. I'm not seeing any stalling in the market. I mean, we just did this. We're making a podcast studio right now, doing a little bit of construction. And I mean, I just bought, I don't know, 3-inch PVC to run some Cat 5 through. And there's our podcast studio we're building out. Three different sets there. Kind of cool. Our scaffolding's up, our rigging for our, lighting, overhead lighting and stuff like that. So we're excited about that. But I spent $1,000 on like 100 feet of pipe. That's stupid. I don't even know how people are affording. This is housing costs, right? It's essentially. But anyway, yeah. So I want to hear from you guys. I believe you guys, the audience, there's wisdom in crowds, right? There's a great book too, by the way. But I believe there is wisdom in crowds. I believe that you guys hold a lot of weight because it's your sentiments and the economy. The housing market is no different. The affordability is shot. That's why I think that we're far from over. That's why I think that we're going to see a more of a decline here, 2023. Housing prices still coming down. They have come down. Mm-hmm. They haven't gone up like they have. But I want to talk about also, we're going to kind of dive into sort of some historical data, because I believe that if we take a look back in history and we can see that this same thing has kind of happened before, I think the echo of what happens next isn't far off. So what I do know, guys, is that when we get out of balance, we have a way of getting back in balance, right? When American people say enough, I can't afford this anymore, and they stop, like we're seeing people reducing their trips to the grocery store. The lines at the grocery store are not existent. I mean, chat in if you're seeing something different than me. I'm seeing grocery stores are slow.
Yeah, they're slow. And, I haven't checked the price of eggs yet. I have not done that. But, I mean, that was out of control there for a few weeks. It could still be. And, people are getting smarter, buying in bulk. I see it. I see it on Facebook. People are commenting about their budgeting and what they found and deals they had. And people are very vocal about it because we're all feeling it some way or another. So, yeah, I'd also like to hear from you guys. Going back to talking about people in the industry, I talk to agents all the time in different brokerages. And just today, 4 of them that I talk to, 2 when they're no longer a real estate agent, they decide to go back to salaried positions, and 2 of them have retired. So more of this. Now, I know that we had at some point, whether it be last year or the year before, there were more, what was it, Todd? More licensed real estate agents than homes for sale on the market, I believe is what it was.
1.6 million licensees or more, I think. Maybe it was closer to 1.7 million licensees, but a lot of these people just got their license the last 2 years. They watched everybody making all this money. It's interesting. We just had an agent come to us and say, look, I'd love to join your brokerage, but can you give us leads?
Yeah.
We want leads.
Mm-hmm.
I guess you do.
Yeah.
You and
Yep.
everybody else.
Yeah. Yeah. It's definitely it's a different time now. It's a different time.
It is. I don't want to suggest that we're going into the Great Depression again or the Great Recession of 2008, but I think there is a probability that depending on what happens in the near future with our job market, I do want to kind of talk about, not that long ago. I'm a history guy. I like looking back. We'll take a couple questions here, but I want to kind of go back. In the description, I said that the American dream of home ownership that I guess we know of has been around for about 130 years. And this really started, I guess, not that long ago. It wasn't 130 years ago when we started to really see it. It was when housing started to appreciate the most. And I want to talk a little bit about that because prior to 1934, we didn't really see a whole lot of home appreciation until the federal government had stepped in and created the Federal Housing Administration that we know as FHA. And when they did that, they actually made a way to reduce the barrier of entry to own a home. Because back in the day, back in the late 1800s, 1900s, early 1900s, when you bought a house, you had to put like 50% down. And the mortgages were only 5 or 6 year interest only mortgages. And basically, they balloon painted it. They had a balloon payment at the end of that term, which meant the whole principal balance, the remaining 50% that they financed, was due. And I think going into like the 1940s, the default rate was huge amongst homeowners that were defaulting on their mortgage. It was like 25% of the people that were financing homes were in default. So what had happened back then is when the FHA came in, they said, look, they did a couple things. They reduced the amount of money that was required down. And then what they did was they extended the loan period to 30 years. And I guess right before they did that, loans were maybe 10, 11 years. They had gone from 5 years to 10 years. And then when FHA stepped in, they moved it to a 30-year mortgage, dropped down the amount that people had to put down. And then during, really after World War II, there was a housing shortage, sort of like it is right now. And what happened was the government incentivized developers and builders to build affordable housing. And we know that in a lot of the neighborhoods, especially locally here in Maryland, we are definitely, a battleground, state. I mean, Pennsylvania right next to us, battleground, and so we had a lot of military housing here. And a lot of these neighborhoods and housing were basically cookie cutter houses that were basic. They were just basic, safe, affordable housing. And a lot of them only had, one bedroom. In fact, only the wealthy people had one-offs or something that was unlike these cookie cutter houses. But in order for these builders and developers to make more housing, more affordable housing, they had to cut red tape and open it up for a lot of these developers to be able to quickly do this. And then the federal government was working back then to make roads and infrastructure and things like that. So that's really when the FHA stepped in and said, we want to increase, because I think homeownership had gotten down to somewhere around 43%, 44%. What they wanted to do was increase it. And then by 1970, we had, I think, about 60% home ownership by 1970. But when FHA stepped in and, or the government stepped in and put these programs in place and they reduced the monthly payment sort of like what happened recently, the prices shoot up. And I think that's what we started to see really in the 1940s. And when the American dream really became, after World War II and this era, that people started to be able to buy a house, and because the payments were low, these builders, developers, and the government could profit more in different ways, right? Taxes, things, fees, permitting, things like that. But that's when we started seeing homes appreciate the way that they did. And of course, with any solid investment, if you're investing in something, what's going to happen? If you're making money in it, then that's an American dream, right? I mean, I want to invest and make money. And, that is the American dream and the American way. So anyway, we're going to dive more into that and kind of pick up from 1970, because this is where things start to echo what it's like right now, today, in today's market. A lot of similarities. And then of course we know what happened in the 90s leading up to 2006. And we're going to talk a little bit about that too. So Melissa, let's take some questions.
Yeah, let's do that. Lots of comments from you guys here.
I think they think I'm drinking scotch too. This is ginger
That has
ale.
been brought up a couple times.
I wouldn't put ice in my scotch. I mean, come on.
Is it whiskey? Is it scotch?
It's ginger
Those
ale.
are, yes, just ginger ale, guys.
I'm boring. Ginger ale. Got a long day tomorrow too.
Oh gosh, I know. How about Heather McGee? Heather, thank you for your question. Do you think more houses will be on the market come this spring and summer?
Yes, I do. I think nationwide. I think we're going to see, because look, people have to sell houses. They always do. And like I said, I think as we're correcting, we're going to probably get back to more of a normalized cycle, regardless of whether the prices are coming down. But the normalized cycle, when we have less buyers in the marketplace and, higher cost or barriers to getting in, and that's why we have less buyers, people are going to get back to trying to hit the optimal times. And the optimal times really are for people to buy in the spring or early summer and then get settled in before school starts in the fall. And that's typically the cycle. And then when we get to the holiday season, towards the end of the year, I mean, people are kind of in a different mode, a different mindset and things like that. So, we are in a industry that has a very cyclical type of, sales pattern. So yeah, but we're seeing it now. We're seeing more inventory hit the market. Not in every market yet. It's still tight. And a lot of this is because sellers are just refusing. Look, guys, I mean, chances are if you bought a house in the last decade, your mortgage is less than 4%. So if we just think about that for a minute, where are they going to go? Where are they going to go? I mean, you can't, what do you want to sell your house and buy less house and pay more? So I think that what a lot of the sellers are doing is they're just kind of, they're refusing to sell right now. They're making other arrangements. People are aging in place. They're moving millions and millions of millennials back home. And we're seeing more multi-generational housing than we've seen in decades. And, a lot of this is because of lack of affordability.
Mm-hmm. How about talking about those? We've got a question here from Corey. How about those, listings that are coming on with more inventory, multiple offers coming in on those offers? What do you think about that?
I
Highly
think that
competitive.
I think right now we're still dealing with a first-time buyer that wants what they want. I mean, I just had a conversation with somebody yesterday and today. It's like, what are you doing? Why are you, and I'm going to say it. I'm going to put it out there. If you're a first-time buyer and after you pay for your down payment, and number one, hopefully you can afford your mortgage. I'm not into the buy downs. I'm not into the adjusted rate mortgages. I was talking to this guy. He's like, my mortgage payment is going to go from It's going to go up a lot. Year 2 and year 3. Okay. Well, you're not going to refinance it in 3 years. That's insanity. If you're a first time buyer, look, if you've done this before and you've owned a home before and you're going in eyes wide open and something opens up, man, and it is exactly what you want and you can afford it and you don't care, buy it. By all means, buy the house. Who I'm talking to here are the first time buyers, right? That have no idea when their rent now is twice the money. It's a mortgage payment, right? Is twice the money. Your utility costs are twice the money. You're now paying the taxes and repairs. And if you're buying that house and you're looking to buy a house and it's your first house right now, and you're not having 6 months of cash in the bank after your closing costs, after your down payment money, if you won't have 6 months of cash in the bank, if you should have a personal financial downturn, forget the rest of the economy. If something were to happen to you where your finances changed, went down, job loss, medical reasons, separation, whatever. Somebody was buying it with you, paying half, moves out, refuses to pay half. If you don't have 6 months of cash, man, I'd sit this one out for now. And that's a bold statement, guys. I'm talking about my own income here, right? I mean, we're in the business to sell houses. But if I'm telling you my honest opinion and you're a first time buyer and you don't have 6 months after you pay everything, you have $5,000 left in the bank or less, I would be holding off, because history tells us, guys, history tells us that we correct. There is a cycle that is, man, it happens time and time again throughout history. We have economic downturns, and it may only be for a couple of years. That's wiped a lot of people out. In fact, when we had the housing market crash in 2008, that started in 2006, almost 4 million people lost their home in 3 years. So if we would look and say, well, it was only a financial downturn for a couple of years, almost 4 million people, they estimated 3.8 million people lost their homes due to foreclosure.
Dig into that just a moment, because we've got a good question here. Someone may not fully understand. El Sayan, why can't you refinance in 3 years? Is it the cost of it?
Yeah, that's a great question. Ask your lender. But let me tell you, and I'm not a lender, okay? So right now, I would still consider that we are not far from peak, right? We have peak to trough. We're going to take a look at that in some data and history, but peak to trough. This happens in pretty much every downturn. We've got a peak price, some kind of a correction, some type of downturn, and then a trough, right? A bottom. We don't know where the bottom is. Sometimes it flattens out before it goes up, but it doesn't always bottom out like it did in the 80s. It just kind of flattened out. But when you go to refinance, first of all, there is a amount of reduction in the interest rate that makes it make sense. That is, you have to talk to your lender about that. But there is a cost to refinance, and that cost, sometimes, if you're only going to keep that house another 3 years or 4 more years, sometimes that cost is not worth doing it, because you have to wait a couple more years, several years, before the savings after that cost of refinancing pays for itself. Okay. But the biggest thing here is, if we continue, the risk is is that most people are only putting down 3%, 3.5%, 5%, whatever, very low down payment. I'm hearing now 0% down conventional loans. And I'm also seeing a lot of VA and where, is 0% down. So they've put no cash down on the principal balance of the loan. And we're almost at what I would consider peak pricing. We're not far from peak pricing. So what that would mean is if we have a downturn and pricing continues to drop, when you go to refinance that in 2 years or whatever, they're going to order another appraisal and your house is going to be reappraised. If the house appraisal is lower, you're going to need to put more money down to even be able to finance. So if your loan was conditional on 5% down, and your value dropped 5% down, you may need to put 10% more down out of pocket in order to get back into a refinance deal. Well, you probably didn't have that when you bought it. That's why you only put 5% down. So they're the risks. Now, okay, there's an upside. Well, interest rates drop and prices skyrocket again. That's possible. I don't think it's probable in the next couple of years. I've been wrong before, guys, but I don't have a crystal ball. But I'm talking about history here.
Mm-hmm. We've got Lisa here. What is the timing of this, Todd? The imbalance that you speak of?
Yeah, well, I mean, we're in a major imbalance right now, in my opinion, and we just look at that and as because there are so many first-time buyers that are in the market right now, but so many of them still can't buy. And that's the imbalance, right? The imbalance is that these home prices are so expensive that now we're limiting this market to the ones that can afford to pay these prices. And these are people that are, I mean, I saw something the other day where unless somebody's making, I think, $82,000 a year, they can't afford the median priced home. And, so now we're looking at, if there's two of you buying a home, but the problem that I'm seeing right now is that people don't want what they can afford. This is the problem. In looking at, what some financial advisors say, and I'm not one, but they say that, this is like some of the worst decisions that young people make is they put all their money in their house, and you're not just going to buy the house. Now you're going to renovate it. Now you're going to do things. You're going to buy more furniture than you've ever owned before, right? And your costs are going to increase. Your repairs are going to happen. So what happens now? You keep spending, right? So now all of a sudden you've spent all this money on the roof over your head. It's hard to get this through to people, especially the younger generation, to say, look, wind it down a notch. Let's wind it down a notch. Look, in 1900, you guys think that was a long time ago?
It sounds like it, but it really wasn't. It really was not that long ago at all.
Well, I can tell you, my grandparents were born in 1902, I think, and maybe 1905. I mean, they're both passed now, but I say grandparents, I had four of them, but sometime in between that, 1902 and 1907, maybe. Okay. So that's my grandparents. That's not that long ago. Right. So when we're looking at this, guys, we've got to look back in the history books because it wasn't that long ago. Right. Back in 1900, less than half the households owned their homes. And over the next 20 years into 1920, it dropped from there. Right. But what happened in the 1920s is we had the roaring 20s. Right? It was a time of boom, right? It boomed. Then basically what happened in the 1920s, America's economy grew by 42%. It's a pretty decent rate, right? But, I mean, we were doing things like crazy, right? We were traveling, people were making more money, the economy was booming. People were like, I mean, look back at the pictures of the roaring 20s, man. They're dancing in the streets. And 1929 was the beginning of the Great Depression. So we went from some of the best times to some of the worst times in our history books. That's crazy, right? That's crazy. 10 years peak to trough.
Mm-hmm.
Right? Stock market crash. So I think it began August of 1929. And by October, the stock market crashes, wipes out people's wealth. It's devastating, right? But it wasn't just fueled by that. There was, we had a collapse of world trade back then. We had more government policies that were added. There were bank failures and collapse of money supply. And that's when home ownership really tanked to under 44%. You know what happened next, Melissa?
I know you're going to tell me.
World War II. Some people think we're close to World War III. I certainly hope not.
No.
Let's take some questions.
Yeah. You got Orlando Rodriguez here. Those that fail to learn from history are doomed to repeat it.
Orlando, you're right.
Yep.
I mean, I think, just me continually trying to keep it, because look, I have to run a business here. I have to navigate agents. I have to navigate staff through this changing economy and come out at the other side, right? We need to be able to make it through too. I want to be still podcasting with you guys in a year or two from now. I don't want, to go bust. So, what am I doing right now? I'm not just spewing this stuff out. I mean, I'm diving in. I'm going to the books. I'm looking back. I'm trying to strategize. I'm trying to plan.
Yeah.
I mean, that's the reality of things, right?
Yeah. And then again, you guys, thank you so much when you give your insight and what actually is going on with you. We've got Paul here. Many who bought in 06, 07 were still underwater a decade later. Not many, but there were a small amount of those who didn't see positive equity until the pandemic started in 2020.
100%. I mean, Maryland here, guys, we like to say that we're so stable here and sort of insulated in a lot of ways because we have a lot of military here. We have a lot of insurance is a big industry and a big employer. We've got Washington, right? I mean, the money flows out of Washington. It doesn't matter who's in office. They always have plenty of money for what it is that they're doing or working on. So, and that, really fuels the jobs. So, and they're decent paying jobs. So our market is stable in many ways. But I'll tell you, we crashed some of the biggest in the country. We exploded the most and then we crashed the most, but we were the slowest to come back. That's what people don't realize. We were very slow to come back. And you're right, with this comment, Paul. I mean, here, some people couldn't get out until the peak of 2022 from 2006.
Yep.
So that's the question here about, housing and being the American dream. I'm all about it. I love when people, own their home and plant their roots and become part of the community and, help business and local business thrive and, build their networks. That's good stuff, right? It plants somebody longer When somebody's in a lease, they have a tendency to jump around a lot more. Somebody buys a house, they plant themselves there typically for many, many years, right? At least 5, 7, 9 years. And, at that point, maybe their life changes to where they need something bigger, smaller, or relocate to another state.
So we've got Orlando giving his thoughts on this. 4 years to the bottom. If you buy now, you are almost guaranteed to have negative equity. What say you?
Yeah, I think, that and Orlando, I would love to know. Believe me. I mean, guys, I would love nothing more to be the one that, calls this accurately and saves everybody a ton of money. And, builds you all the most equity that you can possibly get in buying. Of course, that wouldn't help my sellers out very much. And I have to be faithful to them too, because we do serve buyers and sellers. But I think what we're going to see, and I said it from the start in April of 2022, that we were headed to a buyer's market. And I was criticized by that. And, and we did see it. And, people say, well, you said the market was going to crash, and it hasn't crashed. Well, we're not overpaying by $50,000, $100,000. We're not giving them 10% over list price like the average in the nation. Agents right now, if they are worth anything, the most important thing they're telling sellers is do not overprice this house. It will be over if you do. Price it right. Where before they were like, oh, you want to list it for 50,000 more than what I think? Okay, let's give it a try. And they're like, haha, see, I'm smarter than you, Mr. Agent, because I got it and more, right? Those days are over. So in a way, we have seen a huge correction, a huge crash already. And I said that we would be looking at about 10%. And I think from peak right now, we're hovering somewhere around that 5%, 7%. I think we will go more than 10% from peak. Maybe we'll be 13% or so. I don't think we're going to see 20, 25% drops here. Maybe we'll see that in our over 1.5 million, 2 million. Could we expect to see a house being reduced by 400,000 in that price range? I do think that is possible. But for the median, the meat and potato price range, the sweet spot in every market, the buyers are not going to let the prices dip that low unless we have those other two fallouts, right? Jobs get wiped out. That's why we have to watch the job market, and the Fed, to whether the Fed stays the course. And what will that do? That'll affect the job market. So I don't care what anybody says. I've been through it. When interest rates go up, employers start looking for a way to cut because spending comes down and jobs get cut. So fact, right? So then it'd just come down to, will the government continue printing money and, with its stimulus? But regardless of all that, I still think we're seeing, 10 to 15, 13, 15% peak to trough here locally, and other markets the same.
Mm-hmm. Donna Akers here. Donna, thank you so much for your comment. It's difficult for first-time home buyers due to the prices being so high. The economic status does not support one to purchase a home. Prices are 50 to 100,000 more than what they are worth. Tax increases in areas due to the high prices are causing some to attempt to sell again just to get out from under those homes.
Mm-hmm. Yeah, and I'm having this conversation with people almost daily. And, they're like, oh my gosh, my tax assessment's gone up, right? For the next 3 years. Of course, of course it's gone up. And you know what else has gone up? Your insurance premium. Because insurance rates are going up. So when people are saying that they have a mortgage rate or a payment, it's going to go up. Yeah, it's going up. I want to talk about, and I do want to answer as many questions as we can. But I want to just kind of go over the 1970s because, guys, this is what I feel that we're echoing almost the most. And, we had some of the most inflation in the 1970s. I think year over year inflation and 1970s was 7.1% on average in the 1970s. And in 1979, inflation topped out at 11%. And by the way, that's what the 30-year mortgage rate was back in 1979. But what happened was, in that 1970s, we saw housing prices skyrocket, just like the last 10 years, right? There was an article that was published on money.com, and I think Joe might have that article. If so, we can put it up. But there was an article that I saw the other day, the headline in money.com. It was in November of 2022. And it was referring back to an article that was in 1980. It was a top story in March of 1980. And it titled, guys, this is in 1980, after 10 years of record-breaking inflation, 7-point-some% year over year. And what happened in 1980 is crashed, right? 1980 story headline, bottom dollar for tip-top house. And basically that was this writer, Edward Scharf. He wrote, it was basically exploring a housing market that was in flux. And that bared a lot more than just a few similarities of what we're seeing today. In the late 1970s, this article says inflation was running at about 14%, thanks to 2 oil embargoes in the previous years that had sent consumer pricing skyrocketing, and including home pricing. And nationally, home values increased 14% in 1979, although many markets saw prices grow more than 20%. And here's the key to this article, guys. It was a seller's market. Buyers were purchasing homes regardless of the condition. Does that sound familiar?
Sure does.
Bottom dollar for tip-top house. And in 1978, home prices peaked, just like they did in 2022. The Fed raised interest rates. And from 1978 to 1982, home sales fell 50%. It took until 1996, guys, almost 20 years later, before home sales exceeded 1978. And that's where I'm thinking that we're headed, right? I think we're going to see where it happened again in 2006. By 2010, 2011, there was blood in the streets. I mean, it was terrible. Almost 4 million people lost their homes in the 2008 market crash. I'm not saying this for any other reason, but I want people to think that this can happen again. Stop it. Stop the madness and thinking that it can't. We saw it happen in the early, 20s. We saw it happen in the 80s. We saw it happen in 2008 to 2013. Pull up that chart, Joe, on the median home price. I love this chart because this guy, when people are saying to me like, you've lost your mind and, home prices are never going to drop again, I have to look at this chart when I'm navigating my business here, guys. When I'm trying to decide, how are we going to survive the next couple of years so I can continue YouTubing to you guys. I mean, look at this spike. 2020 to 2022 goes up higher than it has in any other year since they've been documenting this stuff. Let me give you another stat. From 2011 to 2022, the median home price went up 112%. Do you see that anywhere else in that chart? Not only that, but in the last 2 years before we hit the peak, so from 2020 to 2022, 2 short years, of that 112% increase, 45% of it was in 2 years. You know what I think is the result is stimulus, money printing. Got to get some of that money back off the street, right? I mean, I'm not a Fed or I'm not an economist, but my goodness, don't we need to start shredding that money somehow? We need to start reeling it back in a little bit. Well, what's going to happen then? Can we keep printing money? So I don't know. I mean, like I said, I don't have a crystal ball. I'm in this business. I listen to conversations every single day. I hear buyers and I'm like, I get both sides of it. The buyers are like, it's 600,000 now. I want to offer them 395. You think it's too soon to ask that? Yeah, that might not be realistic ever. But then, I get the buyers on the other side who are like, oh, they want 450 for it. What should I do? Should I give them 525? Come on, guys. We need to start looking back at these history books, and that's the best advice I can give you. I don't know what else to say. Let's take some questions.
Yeah, I know it's frustrating. We've got Lex C, who actually is working with one of our agents. And, she said it just really sucks for those of us that have been waiting for a while. And then she even mentions, I'm going to pull this additional comment that she had. I had Jeremy give me a pep talk because this market gives me a headache, LOL. So we know, highly frustrating.
The best thing, look, you have to check your finances, okay? Because the last thing that I want you guys to do, especially first-time buyers, is to not be able to live life and put yourself in a financial burden, financial stress. One of the biggest burdens on relationships is finances. That's not new, right? That's not new. It's one of the most argued, occurrences, situations in a household. Is finances, debt, right? Let's not continue. Who said debt was a great idea? Who said, I know the federal government made 30-year mortgages. We have 40-year mortgages. Let's just never own it. That's really the only way to get the prices to go up again. Drop them like we did back in the 1940s. Create these longer term, lower down payment. How can you get lower down payment? Then maybe there'll be negative down payment. Maybe if you buy the house, you'll get $10,000 back. Maybe I don't know. But at what point are we buying too much? At what point should we say, I don't need that? I need a safe house. Some of the walls aren't falling in on me. The roof's not leaking. Something I can fix if the heating and air system breaks. Not going to have to go further into debt. And I'm willing to not have as big of a house as all of my friends. And I want to live comfortably and be able to do other things and have other investments. I'm not trying to tell you how to live. Look, guys, if you disagree with what I'm saying, by all means, dive in. I'm not trying. You be you, I'll be me. I live this. I've been through the ups and downs. I can talk about it. I earned the right to talk about it.
What about the renting versus the buying? Because we get this question a lot, especially of viewers calling into the office and really needing to know in their area what exactly they should be doing. So we've got Wicked Particle. The real question is if it's more cost effective to rent for the next few years, waiting for the market to flatten out, or to even buy at today's prices. If it costs $4,000 to rent in a 1 to 1.2 million area.
So And this is a great question. And I get this all the time from our audience and calls, clients, uh, family members. You know, if we took a step away from the market as far as the pricing going up and down, right? Trying to predict a crash or trying to predict a bottom and not wanting to overpay. I do understand all that, but a bottom is hard to predict. What I'm really saying here is that this is an affordability issue. I'm watching buyers pay top dollar for houses that, should anything happen to the house as far as a repair need or their job, that they will be wiped out and lose the house. This is what I'm referring to. So, my first advice is, instead of waiting for the crash and trying to predict that, more importantly, be financially ready to buy a house. And what I say is 6 months of cash in the bank to cover all of your bills that you have right now, your credit cards, your student loans, your automotive, fuel, insurance, should you have to pay that if you're let go from a job. Kind of plan, hope for the best, plan for the worst. Can you survive for 6 months with the amount of money in a bank account or in something that can be liquid? House is not liquid, right? That if you have a downturn, can you survive and still pay those mortgage payments after your down payment, after your closing costs, your fees, your moving costs, right? You got to pay somebody to help you move, chances are. You got to rent a truck. You've got to buy boxes, all of these things, pizza for the moving guys. After you spend all your money getting set up, not going crazy on buying furniture, do you have money left in the bank if something were to happen? If the answer is no, that's your affordability question, then rent. And if you're unable to save money while you're renting, you will not save money while you own a home. Chances are that's a true statement, because in almost every scenario, the people that are buying houses, their payments are doubling what their rent is because of the prices of the houses and the cost of financing and paying taxes and paying insurance, right? If they're not doubling, they're darn near doubling, right? Because they're bigger. You're living in an 800 square foot apartment and you buy a 2,000 square foot house. Your utility bills are going up. These are the things that we're trying to educate people, from a affordability angle, affordability standpoint, right? You may qualify for that loan, and that loan officer may say charge, right? But are you going to be eating ramen noodles I love ramen noodles. I lived on them for quite some time. But is that going to be your life? Are you going to be saying, I'd love to do that, but I can't afford it. My friend's getting married, but I can't afford to go to the wedding. These are the things that I'm hearing, guys, that I'm seeing firsthand from people that are, making these huge financial decisions.
So let's just say we've got Blake here. So Todd, real question. Have 6 months of cash in the bank, can make a 30% down payment in addition to this, have a lot of cash in the bank. I am a first-time buyer. Later this year, a good time, you think?
Yeah, I'd watch the market right now. If you see something and it's sitting on the market, the days on the market are up. I mean, usually right now, if you're looking at inventory that is sitting there, getting up 160, 180 days on the market, 4, 5, 6 months on the market, chances are they're going to have a price decrease, and you can beat it to the chase, offer them, a price that will get you the house. Here's the thing that I would say, okay? My advice. If there's a bidding war going on with that home, I would step aside personally, unless it was something that I had to have. If I can have my agent call the listing agent and say, are there any offers? And the answer is not yet. No. Then I'm probably, if I have that money in the bank and I'm ready to go, then I'm going to try and not overpay. I want to try and overpay as little as possible. Safeguard myself on a downturn. Prices will go back up again. That is another historical measure in looking at that chart. Prices have never dropped for very long. Maybe a decade. We have seen it kind of go sideways, dip down, but it always goes back up again. If you stay there long enough, you will get out of it in any situation, as long as it's something that you really love and you want to move. You're in a great, Blake, position. And if I were you, I'd be actively looking for a house. I wouldn't necessarily wait to the end of the year. I would try and get myself the best price that I can negotiate, but I would be looking for something that I really want. I mean, that's, in this situation, you're not going to be affected if the house drops another $30,000 or $40,000 from the price that you bought it. It's not going to wipe you out. And if it's where you want to be, it's a lifestyle at that point, right? It's a cost of living. It's a lifestyle. Some people live in luxury apartments because they want that lifestyle. If you can afford it, by all means, go for it. And that's what I say to my people that have bought and sold before. I'm talking to first-time buyers here primarily. Hey, look, if you've done this before and you're selling and you have $140,000 or $50,000 in equity and you want to spend it however you wish, by all means, do it. Life's short, right? I mean, let's do it. I'm not trying to tell you to, make your life miserable and do something that you don't really hate doing when you can afford to do something else. Some people go away on vacation. They stay in the penthouse suite, the honeymoon suite. Costs $10,000 a night. And some people stay in the $129 efficiency. That's up to you. That's your lifestyle on your vacation. It's not for me to tell you whether you're making a mistake. What I'm seeing is people making financial mistakes that they can't afford. And that's the real issue here. And unfortunately, a lot of these people are the ones that drove the prices up the highest. And they can afford it the least.
Todd, what are you seeing as far as people paying cash for their homes? How many are you seeing, or do you hear about, or your knowledge? We hear people are paying cash.
Yeah, I mean, I've seen a lot less of it, over the last 6 months, but there still are cash deals out there. Most of these are investors. They're coming in, lowballing, wanting, distressed property that's out there. And, so we see a lot of cash in that arena. But we're not seeing the cash, the cash play like we have. Let me have some more of my ginger ale. But anyway, yeah. So we're not seeing the as much cash. And what you have to do at this point, you have to say, like, what is your cash doing for you right now? If you have the cash, it's not a bad thing to do, is park it in real estate. Especially if you can find, a good buy.
Yeah, we've got some more questions here. We got another statement here from Paul. Lots of baby boomers will probably downsize in the next 10 to 15 years. Many will sell their principal residence or hold onto it as a rental, which will add to the inventory in the next decade or so. Thoughts on that, Todd?
Yeah, so a lot of the conversations that I'm hearing, especially with baby boomers, and that's a little bit older than me, I'm not quite, at, there yet, but the baby boomers are really kind of contemplating what happened in the pandemic, because they watched their parents be isolated from family members. And that was a really tough time for a lot of people. And a lot of the conversations that I'm hearing are people that are saying that they are going to age in place. They're kind of setting up their home to, appropriate that. So I have a feeling that we're going to see more people aging in place. We know for a fact, a lot of research is telling us that people heal better at home. They live better at home. And I think that we're going to see more multi-generational housing, people consolidating. I'm seeing that now. I've had clients recently in the last couple of years that have sold mom and dad's house and moved them in. In fact, I know several people right now that are doing that exact same thing. So yeah, I think we're gonna see people staying put in houses. That's what they did in the 70s and 80s, by the way, when they couldn't sell their house because interest rates went up. In the 80s, they just stayed. They just said, you know what, we're going to stay. In fact, a lot of my friends, because that was when I was growing up, and a lot of my friends from high school in the 80s, their parents still live in those same houses. So that's what happened if we learn from history. We had the boom of the 70s, the leveling out in the 80s, high interest rates, less home sales, less people moving around. They had lower interest rates. Interest rates were in double digits in the 80s. Why am I going to sell? Why would I do that? Why am I going to sell my house and give it away and go into an expensive mortgage because our mortgage is 11%. Now they're 15%. Or our mortgage was 8% and now they're 15%. So similar situation as to right now. I think we can learn from the 70s and 80s. If I had to kind of, people say, well, it's not like it was in 2008. No, I like to go back. I think it's more like it was when we had the high inflation of the 70s and the results of people staying in place and not selling their houses and sales being lower for longer extended periods of time. Agents, talking to you now, this is what it's going to be like. You're going to have less sales for probably a bunch of years.
Let's talk about the job market. Delta Digger, thank you for your question. Is the job market strong or is work participation low?
Yeah, isn't that the question? I think so. I think that the job market is strong. And I think one of the reasons is because this inflation is not correcting the way that the Fed expected. And that's why, guys, I think we're holding on by a thread. Because for the Fed to get inflation to a rate that they want to be at, we're going to feel more pain in the jobs market. So I think the job market is strong, at least the people that I talk to. A lot of people are hiring. There is a lot of correction going on because people overcorrected when we were booming. They're starting to see that, but still people are saying, I'm still selling a lot. Prices are still high and they're still selling a lot. It's nuts. So I think job market's strong, but job participation, I think we've had a lot of people exit, but I mean, how do we get the facts on that? I mean, I appreciate your question. It's a great one.
How about this one? Again, talking about the Fed. Thank you, Biz Inc., for your question. Think Fed interest rates will actually reverse or that Fed would just stop raising and let it sit for years? I don't understand why they would reverse unless something is seriously broke.
Yeah, why? I mean, how can they? How can they? How are they ever going to slow things down if they don't pull this money back in, right? There's a lot that needs to happen. They got to get some of this money back off the street. So, they're raising the rates, hoping that spending comes down. The banks are getting this money. The banks are getting freaking very wealthy because they're charging higher interest rates on consumer loans, credit card companies. I've heard talk to people that are paying 29.99% annual rate on their debt, their mortgage rate debt. You guys have heard, if you've listened to our show before, you've heard me say it. I mean, now people are financing their groceries. People are putting their fuel on, they're paying their insurance bills, car insurance on their credit cards, and they're not paying them off. So what we're seeing here is, a massive reckoning with debt. So I think that the Fed, if they want to truly bring disinflation, I don't like that word, but disinflation, I like to see deflation, not stagflation or disinflation, because that means extended periods of time. I like to see prices drop. If we don't see prices drop and we don't see massive wage growth, and it's like a double-edged sword. How does a business pay more money when sales slow down? The Fed's trying to slow down sales. Job market needs to stay strong. If sales slow down, they can't pay. Certain industries they can. So you're going to see probably some big winners and big losers in this jobs market. But I don't see how the Fed can pivot. Not this year. I don't see how the Fed can pivot. I mean, I'm a nobody here, guys. I'm a real estate broker in the small state of Maryland. I've been self-employed since 1989, but what is that? I have to deal with what's being dealt just like you guys do. I'm going through it too.
We got Yusuf here. Yusuf, thank you for being a viewer, and thank you for commenting. Even though I am under contract for new construction house in Pennsylvania, but I don't want to miss your insights every Tuesday. Keep up the good work. Thank you. What are your thoughts on negotiating after under contract?
None. Unfortunately. I mean, you signed a contract. These builder contracts, especially for new construction, are heavily sided, heavily weighted to benefit the builder, not you. And in fact, I mean, I don't even know how much money they spend in having these contracts developed, but they can do things like take 2 years to build your house. How can you ever get a rate lock? Or, I mean, my gosh, I know so many people that got screwed that they lost a rate lock. The builder didn't deliver their house in time. And, and now they can't afford their house. But very little. I mean, how do you negotiate after you sign a contract? It's kind of like the horse is out of the barn. I mean, I'm not going to tell you the default on your contract. You would have to consult your attorney with that. I do know people that walked away from their contracts, but I can't give you advice to do that. Yeah. These guys are pretty sharp, these builders, especially if it's a big tract home builder. They're used to this. They can wrestle pretty well.
Talking about builders, have you heard anything about this, Todd? We've got a question here. Daily Smelly, what do you know about Diamond Age 3D homes? They are building a whole community in Casa Grande, Arizona, using robots. Yeah, interesting.
Well, I believe that. I mean, we're going to see a lot of robotics. We haven't even talked about that. I have a couple videos on that, guys, if you want to check out our channel, and where we talk about automation and the next wave of automation. But we won't go knee deep in that tonight.
Mm-hmm.
But I don't know anything, unfortunately. I don't know anything about Diamond Age 3D homes.
We got this one. Kimberly, saw a home in my price range, asked to look at it. The seller told my agent that they didn't want me to look. They didn't want to work with an FHA buyer and prefer to sell to an investor.
I mean, we're starting to see where, guys, look, FHA buyers were losing out left and right. And I got to tell you, I know recently several deals where multiple offers came in, and there were conventional buyers, FHA, and VA. And the seller's decisions were to take the conventional buyers. And, the reason is because there are, especially if it's an existing home. Now, this is, I don't know. I'm assuming this is an existing home. And chances are that there were things that were wrong with it. And the, appraisal process on a VA and FHA is a lot more stringent of a process because they're looking for safety issues, right? Rightfully so, right? But unfortunately, they would make the seller repair these safety items before they would fund your loan. And that's why, so chances are if they're looking for an investor, there are probably things that are wrong with the home. And then they do have that renovation loan on the FHA, and VA has a renovation loan also, but it's a lot less that is available in the renovation side of it, the construction side of it. VA has a cap. FHA has a couple different programs, and I'm not a lender. I'm getting in the weeds here, but there's more of a streamlined FHA renovation loan and then more of a full-blown kind of, construction renovation loan. Consult with your lender. But in these renovation loans, a lot of buyers don't want to accept, sellers don't want to accept them either because it takes so long to close these types of loans. And there's a lot of kind of red tape that is involved. So unfortunately, in a competitive market where there are multiple offers or there's something wrong with it, the sellers frown on offers that they're going to be held to higher safety inspections.
Mm-hmm. Brody, thank you so much for your comment and what's been going on with you personally. I'm 26 and got my first house very end of 2019, right before COVID hit. If I would have been a few months off, I wouldn't have been able to afford. Have my house appreciated $80,000 in the first year.
Yeah, Brody, congratulations.
Yeah, congratulations.
You timed the market right.
Yeah.
I mean, you didn't know it probably, but gosh, there are a lot of people that wish that they were in your position because you got the best of both worlds. You had great financing rates, interest rates, and you didn't know it, but your price was fantastic, compared to where they are right now. So hopefully you'll get to keep your appreciation. Hopefully things won't in your dip down in your area below, or maybe you'll just keep it a while until we get out of this current state that we're about to, in my opinion, experience.
Mm-hmm. Real estate mindset. Travis, thank you so much for always tuning in and all your efforts and what you do on your channel as well. Oh my God, I just thought of something super cool. I'm going to make jackets like Sachs, but mine will be black with the mindset logo. Love those jackets so much.
All right. Yeah, we get a lot of compliments on these jackets.
Yeah, we do.
One day we'll have them on our website. We're having a new
Yes.
website built for us right now to have a store on it with some gear. And so, yeah.
Yep.
We'd love to see all of you guys wearing the Sachs Realty gear representing while you're out and about, looking at houses, of course. All right, let's take a couple more and then we'll wrap it up, guys. We really appreciate you being with us tonight. Guys, if you like this video or you're getting some good content out of it, one of the ways you can let Melissa and I know is by hitting the thumbs up. It definitely encourages us and keeps us going. So we love to bring this content to you every week. And look, we're a real business. We work this stuff every single day. We're not just YouTubers here. We are a real estate brokerage, and we work. So when it's getting to be, we're on the East Coast. So when it's getting to be 9:30 at night, we've been going since early morning. But we really do love you guys, and we really enjoy bringing you this content. So let's take a couple more questions.
Yeah. We got Ryan Beck. Do you think there is a bubble from homeowners who lost their source of income and are borrowing against their newfound equity that has accrued over the last 2 years?
Yeah, I don't think there's a lot of banks right now excited about their home equity loan, um, especially if they lost income, their source of income. So I don't think that that is the bubble. I think the bubble has been that interest rates were so low. The Fed rate was almost at 0%. For the last more than a decade, we've had mortgage interest rates less than 4%, dipped down to an all-time low of 2.74% for a 30-year mortgage, which was unheard of. We have more people refinancing their home loans. Maybe they were pulling out some equity in a refinance, but I think that basically a lot of what we're seeing is a result of printing money and stimulus. And guys, people have commented and they said, I don't know how you keep talking about the stimulus because I only got my, 3 rounds or whatever of stimulus money. Guys, that's not the only stimulus that I'm talking about here. There was PPP, payroll protection, a program that basically, so much money was written to businesses that, I mean, look, I think some of these businesses may not have even needed it, right? And they gave this, they forgave these loans, this debt, as long as the business followed the criteria, whatever. I don't know what's going to happen with that ever. The people that maybe didn't, but that was huge, right? Then we had this forbearance where you couldn't evict. So people weren't paying their rent in a lot of cases. And so that's stimulus in their pockets, not in the landlords. Then you had the mortgage foreclosure moratorium where, people stopped paying their mortgage payments and the banks are working out things. So they had stimulus there. They didn't have to pay their mortgage payment. Then we had the American Rescue Act that Biden signed in I think July of 21 maybe. When the mortgage moratorium ended, this act still what they did was they said, look, we're going to put this money out there to the states now, and we'll let the states distribute this to people up to $50,000 per household, in many of the states. And basically, what it was is you just had to say that you were still affected with your housing costs. You were still burdened by those costs, whether it was taxes, insurance, your mortgage payment, housing related costs. And there was up to $50,000 available for homeowners that were struggling, with COVID related scenarios. That's stimulus. All of it's stimulus. We printed more money circulating in the economy. That's what fueled, in my opinion, this runaway train. Now it's time to bring it back in.
Mm-hmm. Todd, how about this one? We got Jordan Bressler. How much should housing be per square foot?
Yeah, every area is different, right?
Right.
Every price point is different. So it's kind of hard. I don't know whether I'm still logged back in here. I can see. It's probably I'm not logged back in, but I was going to give you guys sort of an idea. I mean, some markets you're going to see 225, 240, 260 a square foot. Some markets you're going to see $1,000 a square foot. I mean, it totally depends on where you are, and home prices, median home prices. If you're in California on the West Coast, I mean, you may be in that $1,000 a square foot price or more, right? So every market is different. I think the key is, what is the year over year square foot price? And we are seeing where that is coming down. I think maybe we're 4% over 2022 in January, 4% higher than last year. So still not a negative number in sold prices in January, but a lot different than 14% or 22% year over year increases. I think it was 4% January to January, at least locally here in square foot price increase from one year to the next. One more. Let's take one more question.
Mm-hmm. Oh gosh, there's just so many good ones here. How about I mean, robot again. You're always there with the questions. The Southeast is not correcting fast enough, maybe because it was already relatively cheaper.
Yeah, I mean, um, I think every market is different. You know, one of the things that really fueled the Southeast or the Sun Belt region was investor sales, right? They poured into this market. You know, in some cases, you know, they were more than 33, 34, 35% in markets of the houses that were sold went to institutional buyers or investors. We're seeing, you know, a lot of them sell those houses now, like Open Door, you know, really taking a hit big time, major losses actually in their red hot buying, scarfing up of property. I know someplace in Texas, I forget what the county is, but over 40, I think 42% of the buyers that of the houses that were sold in the last 2 years were institutional buyers. So, you know, a lot of it was institutional buyers dominating a market. And then, you know, certainly foreign investors. I know some of the comments that I was kind of catching were asking about foreign investors. You know, Canada, number one buyer of our real estate. So we do have a lot of, you know, China. We do have a lot of out of country buyers that have been buying up our land, our farms, our houses, things like that. But
Mhm.
anyway, guys, we thank you so much. We're going to wrap it up here tonight. And guys, we love you. Thanks so much for spending your Tuesday nights with us. We do post other content throughout the week. You know, if you haven't subscribed to our channel, please take the time to do so now. We'd love for you to subscribe to us. Hit that alert bell. You'll know every time we go live and every time we post content just like this. And don't keep this content to yourselves. Share it with your friends. And this will publish, you know, after we go live. We will try and still check out your comments here and do a follow-up video with that as we did last week. So maybe we'll make that kind of a regular thing to get to some of the questions that we didn't answer tonight. Melissa, thank you so
Mhm.
much.
Thank you, Todd. Thank you, everyone. It's really been very entertaining. Love the history lesson per usual. It's always fun for me and the statistics. So thank you all, and looking forward to seeing you next week.
Definitely. We thank you, Joe, behind the scenes.
Yes.
You're dedicated every week, man, and every day to helping us bring great content to our audience. Guys, until next week, have a great week, and we'll see you soon.
See you soon.